everybody, and welcome back to my YouTube channel. If you are new to this channel, kindly smash the like button, smash the subscribe button, and turn on my post notifications so that whenever I release videos like this, you get my notifications very fast. Thank you very much. So today we'll be talking about three things. Also, I want to talk about the Federal Reserve rate cuts. I want to talk about the Federal Reserve also ending QT and starting QT slowly. And we also want to talk about the 2026 altcoin season. So without much further ado, let's dive into the video. So the Federal Reserve actually ended QT on December 1st, 2025. And the following day, the Federal Reserve actually started what we call QE. No, QT is called quantitative tightening, while QE is quantitative easing. So quantitative tightening is when the Federal Reserve starts shrinking its balance sheet. Do you understand? So that it can control the markets. While QE is when the Federal Reserve starts expanding and buying back assets. Do you understand? So now the Federal Reserve has started the process of QE slowly, because the following day after they ended the QE, the Federal Reserve actually injected $13.5 billion into the banking system via repos. All right, so if you have not heard the term repos before, it's actually used by it's a term used by the Federal Reserve. So it's got like it's another word for, like, they call it overnight repurchase agreement. So they call it repos too. That's another word for that. So those are the terminologies for the Federal Reserve, people that are working in the Federal Reserve. So now the Federal Reserve actually started the process of QE, quantitative easing. So, and they actually started with injecting this $13.5 billion into the banking system. And they will continue to do this monthly, like continuously till mid 2026. So by doing this, the Federal Reserve will make sure that their balance sheet starts expanding again. Though they have been since 2022, the Federal Reserve have been shrinking their balance sheets. I think they shrink it to like 2.4 trillion dollars. So like, but now they have started the easing process. So, and this will actually lead to the 2026 bull run. Now, talking about the Federal Reserve interest rate cuts. So, the Federal Reserve is going to meet tomorrow, or 10th of December and 11th of December. That's a Wednesday and Thursday, respectively. So, they are going to meet, or to have a meeting on either to cut the interest rate by 25 basis points or 50 basis points. So, they are going to meet tomorrow. And look at what the Federal Reserve, Jerome Powell, said in the last meeting. Watch this video.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a quarter percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.75% to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals.
All right, so you have listened to what Fed Chairman Jerome Powell has said. So they have ended QT, though that was their last meeting, but in that last meeting, they plan to end the QT on December 1st, which they have done successfully, and they are now trying to balance their sheets and start to buying back those assets. So now let's talk about 2026 altcoin season. Now in 2026, there's going to be a massive altcoin season. So now I expect the altcoin season to kick off in the first quarter of 2026, which is January, February, and March. And we're going to see like a peak or a massive euphoria of altcoin season in the Q2 of 2026, which is like May, April, May, June. Yeah, April, May, June. We're going to see like a massive rally. So this is when Bitcoin's dominance will start falling. Then Ethereum dominance will start rising to like 15 to 17 to 20%. So that is when meme coins will start doing well. Meme coins will start pumping like crazy returns. Yes, that's when people will be very, very euphoria. They'll be like, oh, this coin is pumping, like it's going to the moon, it's not going to come down. But we have to be careful too when we are in the euphoria phase, because anything can happen anytime from the end of Q2. The bear market can actually start anytime. So if you have found value in this video, kindly subscribe to this YouTube channel and smash the like button, and don't forget to turn on notifications so that you get my notification in my next video. See you in my next video, and bye for now.